Welcome to this video, where we break down the massive $2.1 trillion rotation following the SpaceX public debut. We're looking at what Wall Street actually did once the news hit the tape. Let's dive in. This video covers 4 key pillars of our thesis: history being made, the ongoing market rotation, classic late-cycle behavior, and why keeping an eye on the market's backbone is crucial right now. SpaceX has made history with the largest IPO to date. It is now the 7th largest company on the market, marking a significant structural event for investors. With a market cap of $2.1 trillion at the close, this debut isn't just a headline. It's a massive shift in index weights that is forcing new capital into the market. SpaceX saw a strong gain of over 19% on its first day. However, for a debut of this scale, the initial price movement is secondary. We'll be watching the performance over the coming months. To quantify the debut, the list price was $135, finishing the day with a $2.1 trillion market cap. It immediately became the 7th largest company on the board. Comparing SpaceX's first-day performance against historical trends, it lands in the middle of the pack. But its size makes this performance uniquely orderly for a debut of this magnitude. Professional traders know that day one is just the start. The real judgment of an IPO happens over the next 30, 90, and 365 days as lockups expire and the true demand settles. Mega IPOs impact the tape in 3 ways. They drive new participation, boost overall market energy, and act as a liquidity drain elsewhere as capital shifts to fund the new entry. The next 15 days are critical. We'll be watching the lockups, follow-on flows, and the test of investor demand to see how the market internalizes this new giant. Looking at the day one flow, the largest transaction occurred right on the open. SpaceX has now officially joined the list of volume leaders we track. As we always say, many companies launch with a lot of heat, but the true measure of success is what happens in the days and weeks that follow. To recap, we witnessed a massive $2.1 trillion event, a strong 19% opening gain, and we are now moving into a pivotal 15-day window for follow-through analysis. Under the hood, the market's leadership is quietly shifting. While the main indices may appear stable, this internal rotation is a detail that shouldn't be overlooked. Think of this like a gold rush. You don't necessarily bet on the miners, you bet on the picks and the shovels. Right now, it's those hardware components that are leading the market. Let's examine the relative strength of the Magnificent Seven. They just hit a new low against the SPY. When the market leaders begin to lag while the broader market stays stable, it's often a signal that market leadership is shifting. Since June 2nd, the S&P has been outperforming the Magnificent Seven. This persistent downtrend in relative strength is a textbook indicator of late-cycle market behavior. Why are they lagging? It isn't earnings, which remain strong. It's the balance sheet. Investors are starting to price in the heavy costs of the AI build-out, including massive capital expenditures and rising debt loads. The real variable to watch is the debt. When credit default swaps on these megacaps begin to dominate the market narrative, you can expect valuation multiples to compress. The handoff is happening. Since early June, the S&P has shown it can lead without the Magnificent Seven, proving that market leadership is changing hands in real time. Taking a broader look, small caps have been leading the index since January. This rotation into the Russell is a classic sign of a market reaching further down the cap scale in a late-cycle environment. When you buy the Russell, you're gaining exposure to regional banks, biotech, and speculative growth names. These sectors are currently benefiting from higher interest rates, deregulation, and a renewed appetite for risk. Evidence of this shift is clear in the KRE Regional Banking Index, which just broke to a new high on strong volume. This group is thriving on current economic tailwinds. Looking at this week's rotation, capital is clearly moving. While energy has bled, we see semiconductors snapping back and financials firming up. The market isn't exiting, it is simply reallocating. We are seeing 3 distinct confirmations in the financial sector: the regional bank breakout in KRE, a new high for broad financials in XLF, and strong momentum in industrials. Industrials, represented by XLI, recently printed a massive bullish weekly hammer. It's currently testing key resistance, but the signal sent by this technical pattern is powerful. Market breadth is expanding into the long tail. Genomics, value, and microcaps are all catching a bid. This confirms that investors are hunting for the next expansion home. This chart tracking IWM versus the Magnificent Seven is essential. After a long-standing downtrend, the recent outperformance by small caps is a change that traders need to pay attention to. To recap our second section, the leaders are lagging. The baton is passing to smaller caps and financials, and the current market behavior indicates a healthy rotation rather than a total exit. Finally, we look at the macro map. From earnings trends to the IPO environment, we are seeing the classic signatures of a late-cycle phase. Stay tuned as we continue to track these shifts. Let's look at the cycle clock. It's important to remember that late stage does not mean over. It is a regime that can persist. When signals like IPO mania, small cap leadership, and a pivot from the Fed stack up, the clock just tells us we are in the later innings of the cycle. The mantra for this environment is clear: follow the earnings and the IPOs. Right now, the IPO pipeline is creating the energy that drives a late-stage tape. It is all about where that capital is flowing. The boffins on the sell side continue to upgrade technology earnings estimates. This is vital because as long as the fundamental engine is being revised upward, the call for a bubble top remains premature. We have an FOMC meeting this week. While the market expects a rate hold at 3.75%, the real driver will be the press conference and the tone from the new chair. It is not just about the decision, it is about the commentary that follows. When we look at history, the S&P 500 is only higher about 37% of the time in the 3 months following a new chair's first FOMC. Be prepared for a window of increased volatility as the new regime sets its tone. The higher for longer thesis is the connective tissue for our rotation trade. Supply shocks in oil disrupt CPI, which keeps rates elevated. When you add deregulation and government spending to the mix, you define the winners in this specific regime. Who wins in this environment? Banks, for one, benefit from the net interest tailwind and a steeper curve. Energy acts as an inflation hedge, and cash-generative value stocks tend to outperform long-duration growth names. A quick note on risk. Hindenburg clusters are appearing near the highs. Like any indicator, it can overtrigger, but clusters at a peak are a warning sign that deserves respect, not dismissal. It is a flag, not a forecast. To recap our macro view, we are in a late-cycle regime, awaiting the new Fed chair's tone, and sticking to a higher-for-longer thesis that favors financials and energy. Now, we move to the HPT method. We use 3 pillars: macro, fundamental, and technical, to build our read. We avoid focusing on just one school of thought. We stack them together for a clearer picture. Our framework is straightforward. We look at the macro current of rates and liquidity, verify it with fundamental earnings and debt trends, and then use technicals to find where price actually has to decide. The discipline here is simple. Keep it simple. The market is difficult enough on its own. Your trading process should not add unnecessary complexity to the chaos. For instance, the Nasdaq holding the 2-hour 50 EMA has been a repeatable, reliable pattern since the March lows. It's a simple, actionable technical setup that has consistently worked. Your toolkit doesn't need 50 indicators. Stick to a few you trust, like VWAP, moving averages, and RSI. These are what we use to confirm our entries once price action and flow provide the lead. To wrap up our recap, we use 3 pillars. We keep our tools simple, and we let the price action, like that 50 EMA support, provide the proof. That's the hollow point way. Welcome to this video on market analysis. Today we look at the charts that matter, the instruments that reveal if the market tape stays healthy or if it begins to crack. First, we look at the US dollar. It remains capped below resistance. This is a critical chart to monitor, as a clean breakout would quickly change the outlook for risk assets. For now, it remains contained, and we have an alert set. Next, let's look at the semiconductor sector, or SMH. The backbone of the market is still trending. As long as these essential industry charts maintain their trend, the broader market remains structurally healthy. Regarding recent market moves, our diagnosis is that this was a concern sell, not a debt sell. The bond market never panicked, and until the lenders do, we believe there is little cause for broader alarm. Turning to the Nasdaq, we find the index pressed against resistance. Prices dropped and then recovered to this level. It is currently coiled, waiting for a directional decision. A break upward would signal continuation, while a failure would likely lead to a move back down. Looking at market breadth, the S&P advanced decline line has made a new high. More stocks are currently advancing than declining, which is generally a positive lead for price, even when the index itself is not making new highs. For US 500 futures, we see indecision at resistance. A long-legged doji on the weekly chart suggests a lack of conviction. By layering the anchored VWAP from the top with the 20-day moving average, we define a clear decision zone to watch. Copper has been saved. Even after some potentially alarming candles, it confirmed its structure by holding higher highs and higher lows. This serves as a lesson. Wait for the market to confirm rather than reacting to fear. Gold recently tapped the $4,000 level we previously identified and subsequently bounced. While the structure is not yet complete, this response at that level is encouraging. Across the metals complex, structure is building. Gold is holding at 4,000, silver is testing resistance, and the copper trend remains intact. These are positive indicators for the sector. In the oil market, WTI has broken down, showing a pattern of lower highs and lower lows. It lost key support on a significant weekly candle. While spikes are always possible, the trend currently points downward. Energy stocks are currently flat, providing no clear trend. As crude oil leaks lower, this sector remains directionless. We suggest patience until the technicals show a cleaner, more interesting setup. Bitcoin is currently in a reset phase after a sharp move downward. It requires time to build a base. While there is a small push into minor resistance, we would prefer to see another low taken before trusting any rally. SanDisk, or SNDK, has successfully defended its support level and subsequently received analyst upgrades. As a key component of the market backbone, its performance remains a vital indicator for the broader health of the tech sector. Finally, the EWI South Korea proxy recently tested and held its most traded zone. As long as this backbone and the semiconductor sector maintain their levels, the market remains structurally sound. We continue to prioritize levels over emotion. Let's summarize the market charts in 3 quick beats. Semiconductor stocks are holding their ground, keeping the broader market constructive. Metals are building a base, with gold holding key levels. Meanwhile, oil is breaking lower, serving as a funding source for rotation elsewhere. Moving into our flow map, we examine options, gamma, and dark pools. This is where we identify where the walls are, where the gamma flips, and where the actual size is printed. For SPX this week, we are watching open interest closely. The 7,500 strike is the most struck call zone, while 7,300 serves as the anchor for puts. These levels act as magnets and guardrails as we head toward the weekly close. Here are your key option levels to watch for the week. We have 7,500 on SPX calls and 7,300 on SPX puts. Additionally, watch 700 for QQQ and $35 for IBIT as key zones. Treat these as your primary gravity wells. Regarding QQQ, the 700 level proved to be the line in the sand. When we dipped below it, dark pool activity surged, rallying the market to defend the put wall. In a negative gamma environment, that defense was the difference between a bounce and a waterfall. The defense of the 700 level was critical. If that line hadn't held, the negative gamma dynamics could have triggered a rapid and nasty downside cascade. Looking at single name levels, we are focused on NVDA, TSLA, and IBIT. NVDA has resistance at 210 with support at 205. TSLA is currently stuck in a directionless chop between 400 and 450, while IBIT holds key zones at $35 and $36. When examining dark pools, remember that it's never just the print itself, it's the print combined with price action. We saw a massive TQQQ sweep and record-setting ETF prints that gave us early clues before the market moved. It is not the dark pools alone that define the move. It is about recognizing the print and the price action as a combined signal to gain an edge in reading market flow. To recap the flow section, track the walls at 7,500, 7,300, and 700. Remember that the 700 level defense saved us from a deeper drop, and always look for price confirmation following significant block prints. Moving into volatility and risk, we consider the calendar. Volatility is in the air, and historically, seasonal patterns suggest it could be just getting started as we head toward the fall. Seasonally, volatility tends to climb into the autumn months. While summer can be calmer, history shows that August, September, and October often see increased activity. Keep this in mind when determining your risk exposure. In an election year, the back half of the calendar often gets loud. June and July are typically quieter, but volatility clusters as we approach the fourth quarter. It is wise to map your risk to this seasonal rhythm. Regarding crypto, Bitcoin ETF flows just hit their lowest point since their launch. Counterintuitively, such washed-out flow readings can be the exact place where a new structure begins to form. These record low flows represent a flush of weak hands. While sentiment is currently negative, the key will be watching for a return of buying interest and ensuring those critical support levels continue to hold. The core rule remains: risk first. Always size your position according to the current market regime. Remember, process beats prediction every single time, so focus on managing your trades rather than guessing what comes next. We are now entering the 8th week of the sequence. Our playbook is ready. The key levels are marked, catalysts are mapped, and the possible scenarios are drawn. Now we step back and let the market decide our next move. Here is your battle map for the coming week. These key levels are vital to track. I recommend printing this out to keep as a primary reference on your desk throughout the trading days. There are 4 primary catalysts that will likely move the tape this week. Keep these on your radar and prepare your strategy accordingly. First, the FOMC decision is on Wednesday. Pay close attention to the 2 p.m. decision and the 2:30 p.m. presser, as these are prime times for volatility. Second, watch for follow-through on the SpaceX debut, as day 2 flow often sets the tone. Third, keep a close watch on the 2-year and 30-year bond yields. These are critical indicators for market health. Finally, monitor the semiconductor sector closely, as its performance remains the backbone for the rest of the market's trend. For the upcoming watch list, I have identified 4 specific tells that will indicate how the market resolves its current state. These are simple, binary reads, a break or a hold, requiring no prediction, just careful observation and preparation. The US dollar is the first tell. A break of resistance would be a significant headwind for risk assets. Next, watch the 2-year and 30-year yields, where a break higher in the 30-year could spook the tape. Keep these levels firmly in focus. Third, we watch the support levels on semiconductors. If we lose the trend here, the healthy market narrative will need to change. Finally, observe the Mag 7 and SPY. If they stabilize, we expect relief. If they continue to fail, sector rotation will accelerate. We have identified 2 clean scenarios for this week. The bull case requires semiconductors to hold their trend and financials to confirm rotation. The bear case triggers if the Mag 7 struggle, the dollar breaks resistance, or yields climb sharply. When considering the decision tree, we have 3 paths: a break to the upside, a period of chop, or a breakdown. Respect these boundaries and always trade the range until a definitive break occurs. As we move toward the middle of 2026, it is important to remember our mindset. Be prepared for anything, even the unexpected. We approach the market with a plan, not a wish. Before you take on risk, always run your 3-pillar read. Check if macro, fundamentals, and technicals agree. If they do, size up. If they conflict, prioritize risk management or stand aside. The scoreboard reflects the action. From the strong SpaceX debut to the relative strength in the S&P, stay informed. The energy is moving, and our job is to track where it lands. Thank you for watching this video. Stay simple, stay armed, and let the tape confirm. Be sure to follow us on YouTube, Substack, and Discord for the daily read. Trade well, and I will see you in the next one.